The advent of the blockchain, which is built on the current internet network, seems to be an unsurprising result of this new era. Given the emergence of the internet and its following tremendous growth in the last few decades, the market for cryptocurrencies has grown exponentially over the past 10 years since the invention of the first cryptocurrency, Bitcoin, in 2008. As a result, cryptocurrency has become one of the most alluring and intriguing phrases ever. A 15.2% increase in initial coin offerings, or ICOs, with over 11.5 billion USD raised in 2018 is attributed to presumed interest in cryptocurrencies, which results from a fear of losing out on an opportunity. Hello and welcome to my channel. Today, we will be discussing investment behaviors in cryptocurrency. Why do people invest and what influences investment behaviors? Stay tuned to find out. Don't forget to subscribe and turn on the notification bell to get updates on related videos. Without further ado, let's dive in. Digital money is called cryptocurrency. Blockchain technology, which is used to create this kind of cash, is seen as secure since it can create distributed consensus even among unreliable people. Blockchains used for cryptocurrencies are similar to the traditional bookkeeper's ledgers, except that they are electronic and anybody with access to them can act as the bookkeeper. Cryptocurrencies has attracted and is attracting investors from all around the world. Although Bitcoin is probably the most well-known digital currency, there are currently thousands other cryptocurrencies. One of the newest and most intriguing asset classes available to investors is cryptocurrency. Knowing how to invest in cryptocurrencies. Purchasing and holding one or more cryptocurrencies may come to mind when you consider investing in cryptocurrencies. Although purchasing Bitcoin directly is perhaps the most popular strategy to increase your portfolio's exposure to cryptocurrencies, there are other ways to invest in cryptocurrencies as well. Purchase cryptocurrencies directly. You have the option to buy and store one or more cryptocurrencies directly. Your choices range from the most well-known digital currencies like Ethereum and Bitcoin to comparatively obscure coins that were recently issued in an ICO. Invest in cryptocurrency-focused businesses. There are businesses that either have a partial or whole focus on cryptocurrencies. Your options include businesses that produce mining equipment, such as PayPal Holdings Incorporated or PYPL and Robinhood Markets Incorporated or HOOD, as well as many more with varying degrees of exposure. You can also put money into businesses that have a sizable cryptocurrency holding on their balance sheets, such as MicroStrategy Incorporated or MSTR. Purchase funds with a focus on cryptocurrencies. You can elect to invest in a cryptocurrency-focused fund if you don't want to pick and choose among various cryptocurrency companies. You can choose from a variety of cryptocurrency investment trusts in addition to exchange-traded funds or ETFs, including index funds and futures funds. Some funds that specialize in cryptocurrencies make direct investments in the currency, while others make investments in related businesses or derivative instruments like futures contracts. Become a crypto miner or validator. Mining cryptocurrencies or serving as a validator in a crypto network is perhaps the most straightforward way to invest in cryptocurrencies. The incentives that cryptocurrency miners and validators receive might be held as investments or converted into other currencies. What you should know about cryptocurrency before investing. Cryptocurrency investment is seen as dangerous. Even the most well-known cryptocurrencies have far more variable prices than the prices of other types of assets, such as equities. Future legislative changes may potentially have an impact on cryptocurrency pricing, with the risk that cryptocurrencies will be rendered illegal and worthless. Despite this, a lot of investors are drawn to cryptocurrency because of its potential rewards. If you choose to invest in cryptocurrencies, it is crucial to conduct thorough research on each digital coin before making a purchase. When purchasing cryptocurrency, pay close attention to transaction costs because they might vary greatly between different currencies. Since the cryptocurrency industry is developing quickly, it's crucial to keep track of any new events that can have an impact on your Bitcoin holdings. Investors in cryptocurrency should be aware of the tax repercussions of their use, particularly if they buy or sell cryptocurrency. It's especially crucial to avoid investing more money in cryptocurrencies that you can afford to lose, given how risky cryptocurrencies are as an asset class. Why specific cryptocurrency investment decisions are made by people. Aversion to regret. The emotional response people go through after understanding they've made a mistake in judgment is covered by the notion of regret, sometimes known as the fear of regret. Investors become emotionally affected by the price at which they bought the stock when faced with the possibility of selling it, so they decide not to sell it in order to spare themselves the embarrassment of declaring a loss and the remorse of having made a poor investment. Don't we all detest being proven wrong? When thinking about selling a stock, investors should truly question themselves. Would I invest in this asset again if it were to be liquidated, and what would happen if I made the same purchase? If the response is no, it's time to sell. If not, regret over buying a losing stock and regret over failing to sell when it became apparent that a poor investment decision had been made will result, and a vicious cycle where avoiding regret leads to more regret will develop. When investors learn that a stock they had only considering purchasing has increased in value, the regret theory may also apply to them. By buying only the stocks that everyone else is buying and using the justification that everyone else is doing it, some investors avoid the potential of experiencing this regret. Strangely enough, a lot more people don't feel as bad about losing money on a stock than the majority of people hold as they do about losing money on a stock that is unknown or unpopular. Cognitive accounting patterns. Humans have a propensity to compartmentalize some events, and the differences between these compartments occasionally have a greater influence on our behavior than the events themselves. The unwillingness to sell an investment that formerly had enormous gains but now has a tiny gain is the best example of mental accounting in investing. People become used to robust profits even if they are only on paper. During an economic boom and bull market, investors are more reluctant to sell at the lower profit margin when the market correction deflates their net worth. They compartmentalize their past successes in their minds, waiting for the return of that prosperous era. Loss aversion and prospect theory. It doesn't take a neurosurgeon to understand that investors prefer a guaranteed return to one that is uncertain. We want to be compensated for taking on additional risk. That seems to make sense. The odd part is right here though. According to prospect theory, people feel more strongly when they win than when they lose. People are less happy from equal gains than they are from potential losses. According to the prospect theory, people frequently take more risks to prevent losses than to obtain gains, which helps to explain why investors hang on to losing securities. Due to this, investors happily hold on to a risky stock investment in the hopes that price will increase. A losing streak can cause gamblers to act similarly, increasing wagers in an effort to make up for previous losses. Therefore, despite our sensible desire to profit from the risks we take, we frequently place a higher value on things we already own than we would be willing to pay for them. Another reason why investors might decide to hold their losers and sell their winnings is that they might think that today's losers would soon outperform today's winners, according to the loss aversion theory. Investors frequently make the error of trying to time the market by buying equities or mutual funds that receive the greatest media attention. According to research, money moves more quickly into mutual funds that perform well than it does away from underperforming ones. Anchoring methodologies. Investors frequently believe that the market price is the right price in the absence of better or more recent information. People frequently extrapolate recent trends that diverge from historical, long-term averages and probability by giving too much weight to recent market views, opinions, and happenings. Price anchors, which are prices that are considered significant because of their proximity to previous levels, frequently have an impact on investing decisions in bull markets. The more distant returns of the past are no longer relevant in the judgment of investors because of this anchoring heuristic. Overconfidence among investors. Most people consider their abilities to be above average. Additionally, they exaggerate the accuracy and reliability of their knowledge, as well as the idea that their expertise is superior to that of others. Although many investors think they can successfully time the market, there is a mountain of evidence to the contrary. Overconfidence leads to excessive trading, which reduces profits due to trading expenses. That said, investors can be their own worst enemies. Trying to outguess the market doesn't pay off over the long term. It often results in quirky, irrational behavior, not to mention a dent in your wealth. Implementing a strategy that is well thought out and sticking to it may help you avoid many of these common investing mistakes. Please feel free to get in touch with us directly if you have any questions or suggestions about the subject in the comment section. I'll be pleased to assist. Don't forget to subscribe and turn on your notification bell to know when there are more videos from us. Till next time, bye bye.